In this example, we're going to go through 6 separate steps. First, gather the income statement, balance sheet, and a statement of cash flows. The original financial statements issued by the firms are quite large and contain a lot of information. We are going to simplify and reorganize the financial statements to make them more suitable for valuation purposes. Then, we are going to analyze the historical performance of the companies by using key financial ratios. These ratios will tell us how profitable the company has been and how fast the revenues have been growing. We will use this information as a basis for forecasting future cash flows. We will use a multi-stage model, whereby we make detailed cash flow forecasts for an interim transition period, and we also make some assumptions about the steady state period. Discounting these cash flows will give us the intrinsic value of the equity. As our example firm, we will use Tesla Motors. This is a manufacturer of electrical cars. First, we collect the income statement for the last 3 years. Then we collect the balance sheet for Tesla for the last 3 years. This is the asset side, and the liabilities and equity side of the balance sheet. Then we collect the cash flow statement. While we are not going to use this statement extensively, it provides some information that was missing from the other statements, especially the depreciation and capex. We can simplify the income statement a bit to make it more manageable. This table contains the main items we looked at in the lecture on financial statements. For valuation purposes and for the forecasting of future cash flows, we will be focusing on 2 of the items, the revenues and the earnings before interest and taxes, the EBIT. These 2 items represents the basis for forecasting future free cash flow for the firm. The balance sheet has also been simplified a bit. Unfortunately, as we discussed in the financial statement lecture, the standard way of presenting the balance sheet might not be appropriate for valuation. A better approach is to reorganize the balance sheet so it better reflects the operational and financial assets and liabilities. Following the same approach we used in the financial statements lecture, we arrive at the following reorganized balance sheet. The left-hand side consists of net working capital and net fixed assets. The right-hand side consists of the net interest-bearing debt and the equity. A key issue is how to forecast the future cash flows. We want to use the free cash flow for the firm approach. The free cash flow for the firm is calculated using this expression. But how do we estimate future EBIT? How do we estimate the depreciation, the capital expenditures, and the investment in the net working capital? The approach we're going to use involves using financial ratios. A driver of the growth rate in cash flows will be the growth rate in revenues. We are going to use revenues as the basis for calculating the other parts of the free cash flow equation. We will estimate EBIT as the EBIT margin, the operating margin, which is the operating income divided by the revenues. We will do the same for all the other ratios we will be using. Investment divided by revenues, net working capital divided by revenues, depreciation divided by revenues. The rationale for this approach is that in order to grow, the company needs to grow revenues. And in order to support or maintain the revenue growth, the company needs to invest in both fixed assets and working capital. The amount of profits, EBIT, we also model as a function of the revenues. There are other, more complicated ways of forecasting the cash flows, but the revenue approach we will go through is quite intuitive and simple to use. We start with the revenue growth. We collect the revenues for the last 3 years and calculate the annual growth rate. We see that the growth in the first year was nearly 60%, which fell to 26.5% in the second year. This suggests that the growth in revenues is declining. It therefore makes sense to forecast a falling revenue growth also going forward. We assume that the growth rate falls every year until it reaches a steady state phase. From this year onwards, the growth rate is assumed to be 2.5%. The choice of the growth rate in the steady state period must be equal or lower than the assumed growth rate in the economy, for example measured by the GDP growth. It does not make sense to have a growth rate that is higher than that of the economy in general, since that implies that in the long run, the company will represent a very large part of the economy. that does not make any sense. Therefore, it is prudent to assume the same growth rate for the firm as for the general economy. We can plot our assumptions for the revenue growth as follows. We will see later that this revenue growth rate will determine the cash flow growth rate in a steady state. With this revenue growth forecast, we can easily calculate the expected future revenues for the company. We just multiply the starting revenue in 2015 with the expected revenue growth rates. Next, we will forecast the EBIT or the operating income. We do that by using the EBIT margin, which is EBIT divided by revenues. If we calculate the historical EBIT margins, we see that Tesla has had a declining profitability, declining EBIT margins for the last 3 years. That is probably because this is a young company in the beginning of its life cycle. It is doing a lot of investments and growing, which is quite costly. While the revenues are growing rapidly, as we saw in the previous slide, they are still not high enough to generate positive profits. However, it is likely that at some point in time in the future, the profits will turn from negative to positive. Let's assume that this happens in 2 years from now. The forecast is that the EBIT breaks even in 2017 and that the company is able to increase its profit margin up to 30% in 2021. This margin is quite high, and because we assume that the company has a strong brand. But after 2021, more competitors enter the market and the profits deteriorate until reaching a steady state EBIT margin of 20% in the long run. If we draw the EBIT margin over time, it looks like this. The EBIT forecast is generated by multiplying the revenue forecast with the EBIT margin expectations. Next, we continue with the investments in fixed assets, or the capital expenditures, or CapEx for short. Again, we measure the historical CapEx compared to the revenues. We calculate a ratio of CapEx to revenues. We see that this ratio has increased over the recent years. This suggests that the company has invested a lot recently. Let's assume that Tesla continues to make substantial investments in the near future. The company has been quite successful with its product, and it makes sense that the management wants to capitalize on this success and grow rapidly. In order to grow, they need to invest in the necessary machinery and equipment to make this happen. After a while, there will be less need to grow the asset base, and the investment to revenue ratio should fall. We assume a steady state CapEx to revenue ratio of 10%, and this is what it looks like if we draw the graph. To calculate the future CapEx, all we need to do is multiply the revenue forecast with the expected CapEx to revenue ratios, and this is what we get. Next in line is the net working capital. Again, we use the revenues as the starting point and calculate a ratio of net working capital to revenues. We see that the net working capital is negative. This suggests that the accounts payable exceeds the inventory and accounts payable. We assume that this is not sustainable in the long run and the net working capital will turn positive. We assume that the working capital to revenues ratio increases and reaches a steady state of 10% in the long run. We can calculate the net working capital by multiplying the revenues with the ratio. What we use to calculate the free cash flow is actually the change in net working capital, so we need to calculate the change. We need to subtract the increase in net working capital as the increase represents an investment in day-to-day operations of the firm. Then we come to depreciation. Ideally, we should model the investment into each asset or group of similar assets separately and calculate the depreciation schedule for each of the assets. This is quite time consuming. For simplicity, we can simply forecast the depreciation using a ratio of depreciation to revenues. We see that this ratio is increasing. This is caused by Tesla making substantial investment in recent years. We assume that this continues also into the future as a function of the company's expansion and rapid investments. The steady state depreciation to revenue ratios is assumed to be 10%. This is the same level as the capex to revenues ratio. This makes sense since the capex and depreciation are closely linked. In fact, the sum of the investments and depreciation in the steady state period should be approximately equal since the depreciation is just a periodization of the capex. We then calculate the expected depreciation using this ratio and expected revenues. The last element we need is a tax rate. Let's assume that the income tax rate is flat at 30%. We have now completed step 3, the forecasting of cash flows using ratios. We can collect all of the forecasts into one table and calculate the free cash flow for the firm using the equation at the top. If we also calculate the change in free cash flow, we are able to identify that the growth rate of cash flows is constant at 2.5% from 2025 onwards. The reason that we have a constant growth rate of 2.5% for the free cash flow is that we assume that the revenue growth rate in a steady state was 2.5%, combined with the fact that all the other cash flow elements are functions of the revenues through the ratios. This makes the revenue growth the major determinant of the cash flow growth rate in a steady state phase. In order to calculate a value today, we need to use a discount rate. Since we're using the free cash flow for the firm approach, the relevant discount rate is the weighted average cost of capital, or WACC for short. The weighted average cost of capital is just the weighted average of the costs of debt and equity capital. The weights are calculated from the market values of debt and equity. Sometimes it is difficult to find the market value of debt, and then we use the book values instead. We can calculate the equity cost of capital using an asset pricing model such as the CAPM, the single factor model, or a multi-factor model. The cost of debt is typically calculated based on the rating of the company. For example, we can use the yield spreads from corporate bonds with similar rating. The yield spread is the difference in the yield of a corporate bond over the risk-free government bond. This table summarizes the cash flows we need to do the valuation. We have a transition period from 2016 to 2024. We discount the cash flow from each of those years. If we assume that the discount rate is 10%, then the value of the cash flow in the first 9 years is minus $28 billion. If we assume that the discount rate is 10%, then the value of the cash flows in the first 9 years is minus $2.8 billion. The negative value in the transition period is because the company is growing and making substantial investments in this period, generating a negative cash flow stream. The cash flow turns positive in 2022, but since most of the years, and especially the years closer in time to today, have a negative cash flow, the transition value is negative. The steady state is from 2025 onwards, with a constant growth rate of cash flows of 2.5%. Assuming that the cash flow in 2025 comes at the end of 2025, we can calculate the terminal value by dividing $1,575.6 million with the discount rate less the growth rate. This will give us the value at the beginning of 2025. To calculate the terminal value as a value at the beginning of 2016, we need to discount the terminal value at the beginning of 2025 to the beginning of 2016. That is 9 years. The resulting terminal value is $8.9 billion. The total value of the firm is the sum of the transition value and the terminal value. In our case, it is approximately $6.1 billion. This is the intrinsic value, which is also called the fundamental value or the fair value. We are not finished yet. We wanted to calculate the intrinsic value of equity. What we have here is the intrinsic value of the total firm, or the intrinsic enterprise value. To calculate the intrinsic equity value, we need to subtract the market value of debt. For simplicity, we assume that the market value of debt is the same as the book value of debt. We can therefore use the net interest-bearing debt we calculated in the reorganized balance sheet as our estimate of the market value of debt. The value of equity is therefore $4.6 billion. By dividing this number by the number of shares outstanding, we get the intrinsic share price. So the total number of shares outstanding is 130.95 million, which gives us an intrinsic value of $35.3 per share. The next step is to compare this to the market price. The market price per share of Tesla at 31st December 2015 was $240 per share, suggesting that the stock is overpriced, since the share is selling way above its intrinsic value. If we were an equity analyst following Tesla Motors, we would make a sell recommendation for this stock. An investor owning this stock would therefore be recommended to sell his or her Tesla stocks. In the lecture on the index model, We saw that the rationale for active portfolio management was that some stocks were underpriced or overpriced. This deviation between the intrinsic value and the market value represents the alpha we saw in the index model. We can therefore calculate the alpha for the Tesla stocks. We found that the intrinsic value is much lower than the market value. If the market also figures this out, short selling this Tesla stock should provide superior returns. A short position in Tesla would generate a positive alpha. But what is the size of the alpha? In order to calculate the alpha as a return, we need to make an assumption. Often, it is assumed that the price difference between the intrinsic value and the market value is realized over a, for example, 5-year period. In that case, the 5-year alpha would be 580%. That is the return we would get from selling the stock at the current market price of $240 and then buying back the share when the market pushes the price down to $35.3 per share. On an annual basis, the alpha would be 46.7%. Another important valuation method is valuation multiples. Valuation using multiples is one of the most popular valuation methods in practice. The reason for that may be that it is also a very simple valuation approach, as we will see in the next slide. A valuation multiple is calculated as the ratio of a market value divided by a value driver. The market value can either be the market value of equity or the market value of all the assets, what we call the enterprise value. The denominator in the ratio, the value driver, can be items from the income statement, the balance sheet, or from the statement of cash flows. In addition, other alternatives are metrics created from the financial statements, such as EBITDA. EBITDA is a proxy for cash flows that financial analysts often use, and this is created by adding back depreciation and amortization to EBIT. Sometimes, metrics that are not in the financial statements can also be used, such as oil and gas reserves for valuation multiples for oil and gas companies. When calculating and using these ratios, it is very important that there is consistency between the numerator and the denominator in the ratio. For instance, the market value of equity is a leveraged market value. Therefore, the denominator also needs to be leveraged. Suitable denominators are net income and the book value of equity. These are calculated net of interest and debt and are therefore leveraged. EBIT, on the other hand, is not suitable in the denominator since this is unleveraged. In that case, it is better to use the enterprise value in the numerator. The resulting ratio is the enterprise value to EBIT multiple or EBITDA multiple. The way we use the multiples to value either the equity or the enterprise value of the firm is quite simple. To calculate the company's equity, we multiply a valuation multiple such as the PE ratio, with the earnings of the company. This is much easier than the discounted cash flow approach and much quicker. Unfortunately, because of this simplicity, it is not easy to capture the details surrounding expectations of a company's profitability and growth in revenues and earnings as we could do in the discounted cash flow model. The procedure for using valuation multiples is as follows. First, select a group of peers or comparable companies. These are typically companies that are in the same business or industry as the company you're trying to value. Then, calculate the average multiple, for example PE, for all the companies. Then, use this industry average multiple to value the company's equity, like we did up here. However, there could be an issue related to the effect of leverage on a multiple such as PE. For this reason, it might therefore be more appropriate to use an unleveraged multiple. A popular unleveraged multiple is the enterprise value to EBITDA ratio. Let's go through an example for how we use valuation multiples. Let's say we want to value the Helix Corporation. This is a privately owned company, meaning that we cannot observe its market value. It is a potential acquisition candidate, so we need to find a market value for the company's equity. We have collected both enterprise values and EBITDA for 4 companies in the same peer group as Helix Corporation. We calculate the EV/EBITDA for each of the 4 companies and also calculate the average ratio. We will use this average enterprise value to EBITDA multiple of 10.48 to value Helix's equity. If Helix is expected to earn $10 million in EBITDA, what is its value of equity? If Helix is expected to earn $10 million in EBITDA, what is the firm's enterprise value and what is its value of equity? By using the EV/EBITDA multiple, we find that the enterprise is worth $104.8 million. Since the net interest-bearing debt is $18.6 million, this means that the value of equity is $86.2 million. In this lecture, we have covered two valuation methods, fundamental valuation and valuation using multiples. We have to now treated them as two separate valuation methods. But in fact, it is possible to relate the valuation multiples to the fundamental valuation method. We are going to see how this is done for the PE ratio. Let's start with the following equation that we have looked at earlier. We can express the value of equity as the sum of a no growth value and the present value of growth opportunities. We can express the no growth value as earnings divided by the discount rate. We can rewrite this equation so that the value of equity is equal to earnings multiplied with a function, which is shown inside the brackets. By dividing both sides by earnings, we get the PE ratio on the left-hand side. We have just seen how it is possible to relate the PE ratio to fundamental valuation. Let's look a bit closer at the expression on the right-hand side. We see that the PE ratio is equal to 1 plus the ratio of present value of growth opportunities to the value of no growth. This tells us that the magnitude of the PE ratio is dependent on growth opportunities. The higher the growth opportunities, the higher the PE ratio. We can therefore expect that firms that focus on growth should have a higher PE ratio than more mature firms. Let's look at some companies to see if our expectations are in line with actual data. Here we have two sets of companies. The top selection are low growth companies, mature companies that have been around for many years and have experienced high historical growth, but their future growth might be limited. For comparison, we have the bottom selection of companies, three companies with perhaps larger growth opportunities for the future. The differences in PE ratios is striking. The mature companies have PE ratios in the 10-20 range, while the younger growth companies have PEs ranging from 30 to 450. These observations are in line with expectations we had from the theoretical model showing that the PE ratio is higher for companies with a higher present value of growth opportunities. Over the next slides, we're going to see how the PE ratio is dependent on the profitability and the risk of the companies. Again, we start with the Gordon model. We rewrite the expression by replacing dividends with earnings multiplied by the dividend payout ratio, and the dividend payout ratio is of course equal to 1 minus the plowback ratio, B. We also know we can substitute the growth rates with the return on equity times the plowback ratio. By dividing both sides of the equation with earnings, we get the PE ratio on the left-hand side. On the right-hand side, we see that if the profitability increases, so will the PE ratio. We can therefore deduce that more profitable firms should have a higher PE ratio. Next, we turn to risk. We will examine how risk influences the PE ratio. By using an earlier expression and rearranging it, we see that the PE ratio is a function of the plowback ratio, the growth rate, and the risk. On the face of it, the PE ratio seems to increase with decreasing reinvestment. This does not perhaps make too much sense, but it is important to realize that the growth can also be rewritten as the return on the equity multiplied with the plowback ratio. So in fact, PE ratio both increases and decreases with the plowback ratio. The total effect is not very easy to isolate. We have already seen that the PE ratio increases with the growth rate. Finally, let's analyze the impact of risk on the PE ratio. We see that the PE ratio decreases with increasing risk. The risk is measured with the discount rate. This makes sense since the future cash flows should be discounted at a higher discount rate if these cash flows are riskier.